Welcome to the IFRS for SMEs technical series. I am Carl Vowell, and I help SMEs apply accounting standards to improve reporting, strengthen compliance, and build credibility with banks, investors, and partners. In this video, part of the Technical Accounting for SMEs series, we are looking at Section 13, Inventories. We'll define what inventories are, how they are measured, and walk through cost components, cost formulas, and exclusions. Inventories are current assets held for sale in the ordinary course of business, in the process of production for such sale, or in the form of materials or supplies to be consumed in production or in the rendering of services. Some items meet this definition in principle but are excluded from Section 13. These include work in progress under construction contracts, which is Section 23 revenue, financial instruments that are covered by Section 11 and 12, and biological assets and agricultural produce at harvest, which are covered by Section 34. An entity measures inventories at the lower of cost and estimated selling price less cost to complete and sell. Producers and dealers of biological or mineral inventories at fair value do not use this section. Their inventories are measured at fair value less cost to sell through profit and loss. Costs include costs of purchase price net of discounts plus import duties, non-refundable taxes, and direct acquisition costs. If bought on deferred settlement, any financing element is excluded from cost and recognized as interest expense. Costs of conversion, direct production costs plus allocated indirect costs. Indirect costs include fixed overheads allocated on normal capacity, variable overheads allocated on actual usage. If production is abnormally low, unallocated overheads are expensed immediately. If production is abnormally high, allocation per unit is reduced, so inventory is not overstated. For joint products or byproducts, allocation is based on whether costs are separately identifiable or otherwise on a rational and consistent basis, such as relative sales value. Excluded from inventory costs are abnormal waste of materials, labor or overheads, storage costs unless required in production, administrative overheads not bringing inventories to condition, and selling costs. These are expensed in the period incurred. Acceptable techniques include standard costing, adjusted for normal efficiency, and reviewed constantly. Retail method, sales value reduced by gross margin. Most recent purchase price, practical for certain items. Allowable formulas are first in, first out, and weighted average cost. The same formula must be applied consistently to inventories with a similar nature and use. Last in, first out is prohibited under IFRS for SMEs. For non-interchangeable items, specific identification of cost must be used. When inventories are sold, the carrying amount is recognized as an expense in the period in which the related revenue is recognized. Section 13 ensures inventories are not overstated and costs are assigned fairly, and that revenue and expenses recognition are properly matched. Stay tuned for the next part of the Technical Accounting for SMEs series, where we'll unpack another section on the liabilities and equities.